Like all like all
So, as Aaron says, my day job, I write about economics. I have a column every morning in the Washington Post. But the last few years working on this book, and that's the cover, about the global central bankers dealing with the crisis. So before we get into Bernanke and all these guys and what they do, we're going to go to a more basic question. What is money? We all have some. We all want more. We use it to buy things. But what is it that makes this $20 bill something that you can use to buy a hot meal or buy a couple of movie tickets or maybe one martini over the Four Seasons? It's maybe about 45 seconds of a Columbia education. I'm not sure how the math works out. We take it for granted. It's part of the routine flow of commerce. It's part of the routine way we live our lives and work in a modern society. Well, the important thing in looking at these dollar bills is what it says at the top there. Yeah, the Treasury Secretary's signature is on at the bottom, but at the top, what it says is Federal Reserve note. And what that says is this piece of paper has behind it the power, the authority of the United States, our central bank, Federal Reserve. Well, what does that mean? Well, it means the folks in that building are in charge of it. It's down on Constitution Avenue. They're the ones who determine how much money there's going to be, how much is created. More specifically, it's that group of people, Federal Open Market Committee. They meet 8 times a year in that same building and decide, are we going to raise interest rates, are we going to lower interest rates, are we going to pump more money into the economy or suck more out? That's their job. That's what they do. It's a bunch of economists, some bank regulators. That's their charge. Now we can simplify that even more. So back to that original question, why is that $20 bill worth a couple of movie tickets or a hot meal or a martini at the Four Seasons? Well, pretty much because that guy says so. It's an oversimplification, but it's a useful oversimplification for understanding what money is, where it comes from, and how it works in a modern society. Now that raises another question. Who gave him all this power? Why is Chairman Bernanke somebody who has this vast power over society, over the economy, over the world? And why is it that his counterparts in other countries, at the Bank of England or the European Central Bank or the Bank of Japan, why do this secretive group of economists who meet in these secret rooms and make these decisions, why do they have that power? And to answer that question, you have to go back a little ways. So that's where we're going to start. How did the central bankers come to exert this power to begin with? To answer that, we have to go to Stockholm, Sweden in the 1600s. Now, this was an emerging empire. This was a great power at the time. They controlled most of Scandinavia, a little bit of Germany, the Netherlands, the Baltics. It was a power on the rise. But they had a problem in 17th century Sweden. And it was this. Their money was not terribly useful. Everybody was using metal for money back then, and most places that was gold or silver, but what they had in Sweden was copper. So they had these copper plates called dollar. Now, you look at that, you can see the problem with that being your money. It's a little unwieldy. It's a little bit heavy, weighs about 40 pounds. It was held on bank tellers' backs. But that was their money in 17th century Sweden, and it was horribly inefficient. It was not something that they could use to funnel money where it was needed, to capital. They couldn't get capital in the hands of the businesses trying to expand. It was a very rigid kind of money supply. So they needed a banker, and they went to the Netherlands for a banker, and they found a guy who was the first central banker in the history of the world. Now, unfortunately, his story is not a particularly bright one. He's a bit of a huckster when you really get down to it. This is Johan Palmstra. He was born in Latvia. He was a banker as a young man in Amsterdam, went to a debtor's prison, changed his name to Johan Palmstra after he got out of debtor's prison, moved to Sweden. We don't know what he looked like. We don't know what his personality was. Very little in the historical record has survived. But we do know this. He was somehow able to persuade the Swedish crown and the Swedish leaders that he was such a trustworthy person, such a knowledgeable person about the workings of finance, that he should be entrusted with this great emerging powers money supply with its banking system. And so Johann Palmstrup opened what became the first central bank, called Stockholm's Banco. Now, at Stockholm's Banco, they took in these copper plates and put them in the vault, and would give you a note, a piece of paper, saying, yeah, I have those 15 big copper plates in the vault. And it pretty quickly became clear that, that's a kind of useful innovation. Why don't you make it possible to trade, to buy goods and services using those pieces of paper? Why, why limit it to big copper plates that you use to buy things when you have this convenient piece of paper? More than that, why not make it the case that you can issue more paper than you have copper dollar in the vault? What's to stop you? Everybody doesn't need their copper at the same time. You could issue more of those, and there'd be more economic activity and more prosperity. Everybody's better off. That is how the first paper banknotes came to Europe. Johann Palmstrup invented money, as we know it now. Now, that worked for a few years. There was an economic boom, and there was a land boom. The noblemen would buy their real estate using this paper money. You'd finance your inventory of pickled herring, whatever the case may be in 17th century Stockholm, until they devalued those copper plates. And suddenly everybody said, ooh, I'm not sure how much this thing's really going to be worth in the future. Maybe I'll go to the bank and get my copper plate back. I'd feel a little more secure if I did that. But as mentioned, they didn't have enough copper plates. They had issued more paper money than there were copper plates. So suddenly, you've all seen It's a Wonderful Life, the movie takes place in the 30s. I like to imagine Johann Palmstrup was very much like George Bailey. Oh, you don't understand. I don't have your money. It's tied up in Mrs. Christensen's estate. It's tied up in Mr. Nielsen's candelabra. It's tied up in Mr. Johnston's pickled herring inventory. But the system came crashing down. He had all these people coming and begging for their money back. He didn't have enough to give them. That's how Johann Palmstrup got sentenced to death, actually, in a court case. His sentence was commuted. He died a couple of years afterward. So it was not a happy ending for the first central banker. But something did come out of that was more lasting. Even though Mr. Palmstrup had to go to jail and died soon after, they needed something, some entity in Sweden to handle their money supply. They realized there was a lot of good that came from this free flow of commerce. They wanted to preserve that while having a more stable financial system than what Mr. Palmstrup created. So they created what was the Riksbank. And to this day, that is the central bank of Sweden, country of 11 million people. So it's a sad story, that first foray into central banking, but it's also one that has a bit of a happy ending. Now that was the first central bank, not a particularly happy story how it ended up, but what country after country found in the years that followed is that they also needed some way to have a supply of money that could adapt to what the economic circumstances of the day were. In the 19th century, so the Bank of England was started about 30 years after the Riksbank in 1694. That became a way the British Crown was able to finance its expansion and the British Empire. We think of the story of the British Empire as one of the Industrial Revolution and the rise of coal fields and shipping networks that went across the seven seas. What people don't understand is what a role the City of London played in the British Empire. It was the fact that there was this financial sector in the City of London that had this ability to route the savings of millions of savers in the countryside, farmers, merchants in the countryside of England, toward the productive use that formed the Industrial Revolution. Big factories, shipping ventures to India, to Hong Kong, to the Americas, wherever it may be. That was a crucial part of Britain's ability to be the empire on which the sun never set in the 19th century, and the Bank of England played a crucial part of that. 1866, a bank called Irwin and Gurney collapsed, went under in the City of London. Money was freezing up. Money markets were freezing up. Suddenly, people who were comfortable lending to each other at a convenient manner to ease the flow of commerce in Victorian Britain, they were no longer willing to do so. If Irwin and Gurney could go under, what other bank's going to go under tomorrow? Maybe I won't get paid back. So the Bank of England said, we will be the lender of last resort. We will stand here ready to lend to this man and that man on good collateral, and what would be good collateral in normal times. We will make sure that free flow of commerce continues, and so the sun would not set on the British Empire that year. That was one of the better moments for central bankers. Now, there were some lowlights too, as this process happened of these economists coming to exert this power over our world. And one of them is in 1923 in Weimar, Germany. After World War I, you have Germany. They have these huge reparation bills that they owe to the Allies, and it was really a difficult economic situation. There's a man named Rudolf von Havenstein. He was a very civilized man, a lawyer by training, an honorable public servant. He was also the worst central banker in history, because he viewed it as his duty okay, the German government needs money, it might collapse otherwise, I will print as much money as you need to fund that government. There's these amazing speeches that I quote in the book of him being so proud of the physical ability to create 1 billion Reichsmarks overnight and ship them out by plane to the different far corners of Germany. The result, of course, was the Weimar hyperinflation. You have people needing a wheelbarrow full of cash to go buy their groceries. It was destabilizing. The very week the Weimar hyperinflation peaked was also the week of the beer hall Putsch, where Hitler had his first kind of foray into great prominence. 5 years later, 7 years later, Great Depression. There's no reason the Great Depression had to be great. There was a U.S. stock market crash in October 1929. Who cares? Stock markets go down all the time. There's no reason that a decline in the U.S. stock market should cause a collapse in the industrial production of Germany or Britain. There's no reason that a U.S. stock market crash should translate into the rise of the Nazis and a global war. The reason that happened is because the central bankers of that era failed miserably. They were all focused on their own domestic economies, they were all focused on keeping their own currencies pegged to gold, and they weren't able to look around and have a common economic framework to understand how the world works and how they can work collectively to keep the entire industrialized world from collapsing. The result, of course, was all those nasty things. It was a collapse in the global banking system, a collapse in industrial production, a collapse in agriculture, a collapse in the world economy, the rise of the Nazis, and a lot of terrible things. So this is not a uniformly positive story. These central bankers, they've gotten this great power over the years, but they've often used it pretty badly. But they have, over the decades, learned from their mistakes. And when you get to the mid-2000s, you have a universe of central bankers who feel like they've pretty much conquered the things that can go wrong in an economy. They've learned those lessons. We know how to prevent inflation. If you have an inflation problem, you know what you do? You raise interest rates, you tighten the money supply. Less money means less inflation. You know what you do if there's a depression, if there's a recession? You cut interest rates, pump more money into the economy, you get growth going. You know what you do if there's a financial crisis, if there's a freeze up in the banking system? You flood the system with liquidity, you bail out the banks. We know how to do that. So you get to 2005, 2006, and there's this sense among the central bankers, and I've been to this conference in Jackson Hole every August where they sit around and talk about big ideas. There's a sense that we've solved the world's problems. So we get to 2006, 2007, and we have 3 guys who are in charge of the world's money supply for the Western world. That's Mervyn King on the left. He's the governor of the Bank of England. Tim Bernanke, you probably know, the chairman of the Federal Reserve. Jean-Claude Trichet, the president of the European Central Bank. Now, I'm going to take you to a day, August 9th, 2007. It was a Thursday. I think most of us don't remember what we were doing that day. I was actually finishing my final exams from Columbia Business School. But on that day, 7:30 in the morning, Jean-Claude Trichet, on the right there, he was on vacation in St. Malo, in the Breton coast of France. Phone rings at 7:30 in the morning. It's Francesco Papadilla. He was the head of the markets desk at the European Central Bank. He's over in Frankfurt. Monsieur Trichet. Papadilla is actually Italian, but I don't really do an Italian accent, so we're going to do a French accent. Monsieur Trichet, we have the problem. The problem was this. The U.S.-based subprime mortgage securities had been falling in value, and a lot of European banks had bought these subprime mortgage securities. And suddenly, they'd been falling in value so fast that nobody's quite sure what they were worth. And so the banks that normally trust each other implicitly and would happily lend money to each other were starting to panic and say, you know, I'm not sure if Mr. Deutsche Bank down the street or BNP Paribas over there or Société Générale down in Paris, I'm not sure if he's going to pay me back. I'd rather not lend to him at all. The immediate cause of this was BNP Paribas had said it was going to freeze 2 funds and not allow reimbursements because it wasn't sure what they were worth. But that doesn't really matter. What matters is the banking system in Europe was freezing up. And Jean-Claude Trichet, the president of the ECB, it was his job to decide what to do about it. He immediately started a series of conference calls. He got his colleagues across Europe on the phone from the ECB. Now, this is a moment where the habit of Europeans of taking long August vacations was a bit of a problem. So he had to find people, this villa in Greece or this, this estate in Switzerland, wherever it may be, and get them all on the phone to figure out what are we going to do about this freeze up in the European banking system. We're the lender of last resort. What are we going to do? They decided this: we're going to do what's called fixed tender full allotment. We're going to say this is our interest rate. If you need money, bring us collateral, we'll give you as much money as you could possibly need at our target interest rate. We're opening the doors. 49 banks took 95 billion euros that day. Same day, August 9, 2007. Mervyn King, the man on the left, the governor of the Bank of England, he also had a day off. He was going to a cricket match in the Kennington Oval in South London. Took his car from his apartment in Notting Hill. He had told his office, I really want the day off, I'm on vacation, don't call me unless it's an emergency. This created a bit of a dilemma for his colleagues. Was this enough of an emergency to call Mervyn King on his day at the cricket match and interrupt his day of relaxation? They did decide the answer is yes, so he didn't get the call and decide what to do. But Mervyn King and the Bank of England during these early days of the crisis took a different view of things from Trichet and Mervyn King. They were more worried about moral hazard. They were worried about this idea that, these banks made these bets on U.S. subprime mortgages. If they're in trouble, if they can't handle it, that's their problem. They need to suffer for their sins, take the losses. If there's a little pain to be had, well, that's healthy. That's enforcing market discipline. We're going to sit back and see what happens. That was Mervyn King's view. Same morning, August 9, 2007. This is a few hours later because of time zones. Ben Bernanke is on his way to a 7:30 a.m. breakfast with Hank Paulson, the Treasury Secretary. He's in the back of a black Cadillac coming from his apartment at his row house on Capitol Hill, going down Independence Avenue. It is very nice to have your own police force. Ben Bernanke has his own police force. The Federal Reserve Police were driving him down the street to meet the Treasury Secretary. He got an email about 7:20 in the morning from not Jean-Claude, not somebody in Europe, but from the Federal Reserve Press Office, a guy named Dave Skidmore. And the email said something to this effect. The exact wording is in the book, but Mr. Chairman, just thought you should know about this. Apparently, the ECB is doing a dollar financial rescue of a bank. There's something involved in Deutsche Bank and 3 funds they couldn't value. Now, all the details of that were basically wrong. It was the Paribas, not Deutsche Bank. It was 2 funds, not 3. It was euro-denominated loans, not dollar-denominated loans. But this is how, in a kind of moment of crisis, information gets conveyed. Sometimes it's not exactly right. So Ben Bernanke had his meeting with Hank Paulson. They discussed it. He got more full information as the day progressed. Then the Americans had to decide what to do. They were closer to the Europeans than the Brits. They were also ready to do what it took to pump money into the financial system and keep things going. Now, what began that day is kind of an amazing thing. We think of it as a U.S. crisis, a U.S. Thing. It's really something a lot bigger. This was a global crisis. Yes, it started with U.S. subprime securities. It expanded to Lehman Brothers. But it's something that jumped across the Atlantic. It jumped from the banking system to the financial markets, to the real economy, to sovereign debt, back again, twirling around, up and down. And it was the beginning of the first mega crisis of the 21st century, something that's shaping the world economy as we know it and as we're all going to live it for really the remainders of our lives. A couple of scenes from this entire period that I think characterize and help understand kind of what this was. The first one's personal and actually has no great import at all. September 14th, 2008. That was about a year after the events I was just telling you about. It had been a long time. I've been covering the Federal Reserve for the Washington Post. It had been a long year. And on that day, September 14th, 2008, it was a Sunday. And I had been working for about 2 weeks straight, haven't had a day off. Fannie Mae and Freddie Mac had been bailed out the weekend before. And so I went to my favorite bar with some friends and was watching the Redskins-Saints football game. It started at 1 p.m. And in the first quarter, I get an email from a source at the Federal Reserve on the BlackBerry. It says, hey, are you in the office? And I responded, no, should I be? Back. You might want to be in the office. So thinking I'm clever. Can it wait till halftime? Response, you might want to be in the office. What happened that day, of course, was that Lehman Brothers was allowed to go bankrupt. Merrill Lynch was bought by Bank of America. The rout was on. That was the real beginning of what started as a thing that existed in certain money markets, and that translated, that's the moment that translated and turned into a problem, crisis for the global economy and the global financial system. There were things going on at this time. There's the AIG bailout, it was $85 billion. There was a series of bailouts, and those have been reported on a lot. I tell a lot of the details in the book. I'm going to focus on one aspect of that whole series of bailouts and rescues that I don't think a lot of Americans know about, but I think helps capture what was really going on this time. And to do that, I'm going to start by going back to what I said earlier about the Great Depression. When the central bankers didn't have a common understanding, a mutual understanding of each other, their purposes, their goals. By 2007, 2008, 2009, that changed. This is the Bank for International Settlements. That funny looking building in Basel, Switzerland. Basel train station is over to the right. 6 times a year, the leading central bankers go to Basel. They have 2 days of long meetings. They all discuss big economic ideas, what's shaping the world economy, what the heck is going on. What happens on the Sunday nights of these weekends is what I call the world's most exclusive dinner party. It's the ECB, the Federal Reserve, the German Bundesbank, the Bank of Japan, the Bank of Canada, the Brits. All of the world's leading central bankers go to the 18th floor of this building, have a private dinner. They drink great wine. They have good Burgundy and Bordeaux. They jokingly call it Grand Cru BIS. Good food, buttery sauces, lobster, lamb, duck. And what's formed over those dinners, and more broadly across this range of kind of meetings they have in all kinds of international forums, is a sense of common purpose, a sense that we are in this together. And yes, I may be German, and you may be American, and you may be Australian, or Canadian, or Japanese, but we all have this shared goal of a prosperous global economy, and we understand where each other come from. They understand each other in a way that, if you talk to finance ministers, or foreign ministers, defense ministers, there's always a level of foreignness, a level of we don't really understand each other. That breaks down here because they served for a long time. They're all economists. They all speak great English. They share these intimate bonds, and that creates something special. So what does that mean in practice? What did that mean in the fall of 2008 when the world was imploding? Swap lines. So, as I said earlier, this is something that a lot of Americans aren't too up to speed on. So what happened? The European banks had all these assets on their balance sheets that were dollar-denominated assets. They had U.S. subprime mortgages, other U.S.-based securities, and those had fallen in value. Now, normally, what they would do when they had a shortage of dollars, they needed dollars on the liability side of their balance sheet to match the dollar assets on the asset side. They could go to private markets, borrow them from other banks, be in fine shape. This was an atmosphere in fall of 2008, no trust. Nobody trusted each other. Those markets froze up. So they needed dollars, but they couldn't get them. Well, the central bankers figured out a workaround, and it worked like this. The Federal Reserve would enter a contract with the ECB, Frankfurt, and send, say, $20 billion over here to Frankfurt, and the ECB would send a comparable amount of euros back to the Fed. It would be a 90-day contract, let's say. Then the ECB would take those dollars they got from the Fed and lend them out to European banks, and in exchange for collateral. And then after 90 days, the transactions would unwind, and the ECB would get its money back with interest, and the Fed would get its money back with interest. What this was is a way that the Federal Reserve could essentially pump money through the ECB to the European central banks, not just the ECB, but the Swiss National Bank, the Swedes, the Brits, and so on. Now, this is this is not something like the U.S. taxpayers actually made money on it because all the loans were repaid. But this is an example of this kind of international sense of connectivity. It was more than just the contractual arrangements they had to protect U.S. taxpayers. It was also this sense of common purpose where the guys at the Fed, the guys at the ECB, they understood each other and felt comfortable entering that arrangement. How big was this? $580 billion for peak. Again, I don't think most people were aware of this. AIG, everybody freaks out about the AIG bailout. That was $85 billion. This peak was $580 billion. It involved all these different countries and central banks. But that's an example of where this sense of common purpose allowed the central bankers to come together to create a flood of money using this power they uniquely have to create money out of thin air to try and deal with the global economy.
So 580 billion originating from the Fed
Right.
to all these other banks?
Right. So that was, I mean, some were bigger than others, but that was the peak amount. It was. Now, so we get through the crisis, we get through this this wrenching period, and they essentially create a wall of money surrounding financial markets, trying to contain this spiraling loss of confidence in the financial system. And they prevail. Markets bottom out in March of 2009. A lot of the worst was over then for the world economy. By the summer of 2009, the U.S. economy had bottomed out. There seemed to be a recovery starting to begin. We get a year later, we get to 2010, and a lot about this recovery is disappointing. It turns out that an economy coming out of a financial crisis has an entirely different set of dynamics from a normal recovery. And we're all feeling that in 2010 pretty strongly. Which is this. Unemployment was still very high in the 9 to 10% range. Inflation was very low, in the 1 to 1.5% range, not the 2% the Fed used to. And interest rates have already been at zero since December 2008. So Ben Bernanke and the Federal Reserve have to decide what to do about it. And there was this fierce debate over what became QE2, quantitative easing. There's just a couple things on QE. So the notion is, all right, we can't cut interest rates anymore. We're already near zero. If you go below zero, suddenly you're essentially taxing people for their money in their bank account, which doesn't work well for a lot of reasons. So we have to find some other way to pump money into the economy to try and keep the economy growing. Ben Bernanke and the Fed decided we're going to pull that trigger. We're going to buy $600 billion of bonds. That was QE2. They've done several more rounds since then. Trying to get inflation up toward 2%, trying to get unemployment down. Now, I've actually seen where they do QE. Now that might sound strange, but ultimately, any of these monetary policy things, the money has to come from somewhere. And it turns out where it comes from is not a terribly impressive scene at all. You might think, oh, look at this big room. We're here for just a nice alumni event on a Monday night. I can tell you this, the room in which they created that $600 billion is a lot less impressive than this one. So here's what QE consisted of. Saying, all right, interest rates are already zero. We need to do something else to pump money into the economy. Let's buy bonds. And in that particular round, it was $600 billion in bonds, longer-term securities. So the Federal Open Market Committee, that group we saw around that table in that earlier slide, said, all right, New York, our friends at the New York Fed, your job is to buy $600 billion of bonds over the next 6 months, $75 billion a month. Get to it. And so I've seen where they do that. And it's this very impressive room where you have 3 younger people up against the wall. You have a CNBC in the background. There's a supervisor back here. You have a phone line open to all the primary dealers, the 19 major banks around the country. Maybe a supervisor off to the side. Some Dunkin' Donuts that particular day. They alternate. Sometimes it's Danish, sometimes it's donuts, sometimes it's a bagel. But there's always some form of breakfast pastry to enable the printing of billions of dollars. This particular day, they accepted bids. They were going to the market and buy $3.5 billion worth of bonds. They took bids from all these primary dealers, and the computers figured out which ones were offering the best price. They bought $3.5 billion bonds. The quick clack of the keyboard, that money was invented out of thin air. It was on the balance sheets of the banks, and they had those bonds on the balance sheet of the Fed. So the reason I show you that picture and explain kind of what QE actually consists of is I think there's a lot of fear mongering around this, and there's a sense of, well, we're printing all this money, it must be bad. And I will acknowledge there's some ways this could go pretty horribly wrong. There's inflation. You can imagine a world in which printing all this money is going to ultimately circulate through the economy and create either a 1970s style, 10% inflation, or even a Weimar hyperinflation. I think that's highly unlikely. I think the Federal Reserve System, they understand inflation a lot better now than they did in the 1970s, and certainly better than the Germans did in the 1920s, and are highly attuned to any risk that prices are really going to pop. And I think some of the people who have been warning about inflation for the last 5 years have started backing away because we're below those targets. We're at 1.2, 1.3% inflation. That's really lower than the Fed wants, not higher. So I think some of the inflation warnings have really not come true so far, and I'm skeptical that they will anytime soon. That said, it's worth watching. It's a risk. You absolutely have to concede it's a risk. Bubbles. You're printing all this money, goes into the financial system. We've just seen in the last few months this great run-up in the stock market and a lot of bond markets. Are those markets getting out of whack? Are they getting beyond fundamentals? Is all this money that's printing, is it ending up in these different corners of the financial system, creating the seeds of the next collapse? Again, I can see it's something we've got to pay attention to and worry about and focus on. That said, I think so far this is more good than bad. I look at different valuation measures in the stock market. I think they look about as healthy as they've been in my adult life. The idea that you're completely out of whack with fundamentals, earnings have been rising over the last 5 years, I think is just wrong. But it's again something I can see as one of these risks that we have to pay attention to, and if anybody who cares about the economy and what's going to happen in the markets has to be aware of. So where does this all take us? All right, we've been through this epic 5 years of chaos, of ups and downs in financial markets, of ups and downs in the real economy. We've seen the global central bankers deploy powers that I think most of us didn't even know they had 5 years ago. There was a little story from 2008 when Ben Bernanke and Hank Paulson went to Capitol Hill to tell them they were doing the AIG bailout. They go in and they say, yeah, Ben Bernanke, we're going to bail out AIG with $85 billion. Barney Frank says, you have $85 billion? And Bernanke says, I have $800 million. Now that was the size of the Fed balance sheet at the time. Now the Fed balance sheet is about $3 trillion. And really, what we learned is there's not really a cap on it. When you have the bottomless power to print money, the scale of your intervention, the size of what you can do is really not limited at all. But that is an awesome power that society has granted these people, these men, these institutions. And I think we all as citizens, as people who care about the economy, who care about the future of the United States and the world, we have an obligation to pay attention to what they do, to monitor what they do, and to ask hard questions. We have our lawmakers, Bernanke and his successor go before Capitol Hill multiple times a year. They should be asked hard questions about what they're doing and why. If any of these risks do start to emerge, if we really do get asset bubbles, if we do have an inflation risk, we absolutely should be asking hard questions and ensure there's accountability and that these powers that the central bankers have are not exploited and don't lead us to the worst place. At the same time, I'm a strong believer that what they did kept us from some pretty horrible outcomes. And they did a lot of unpopular things. They did a lot of things that should make anybody who cares about democracy, transparency, accountability, that should make us nervous and uncomfortable. At the same time, it's better than the alternative. And they were consistently the ones able to move on a speed and on a scale commensurate with the crisis that we faced in a time when presidents and parliaments dithered, were too slow, too tepid, too reluctant to do what it took to contain this economic calamity. So I end this ultimately on a positive note. I think central banks, the central bankers are something we need in a modern society. I think that we have a lot to be grateful for Bernanke and his colleagues for how they've guided things the last 5 years. But I think it's on all of us to ask hard questions and make sure they don't blow it in the years ahead in plenty of ways they could. So thanks so much for having me. I'd love to answer whatever questions or comments or thoughts you might have.